Hi, everyone. This is Chris Maxey at Wellspire Advisors. We are back with Markets in 2 Minutes and wanted to go through one topic in particular that I think has become very relevant over the last 18 months, and that is what's going on in fixed income markets in the past and how to think about that as we look towards the future. So what you're seeing here is yield to worst for a widely accepted benchmark of fixed income, which is the Bloomberg US Aggregate Bond Index. And as you think about what yield to worst means, it's essentially what is the amount of yield that you would anticipate to collect on your investment in a fixed income security over the coming years. And right now, as you look at the early February date there, it was at 4.3%, which is quite a bit higher than we had seen in a really long time. Certainly that had come down from where it was earlier in this year and the latter part of 2022. But at 4.3%, this is still much higher than we had seen in a long, long while. So this was a function of a couple of things. One, bond prices having come down, interest rates having risen, as we've seen and all heard what the Federal Reserve has been doing and the impact that that's had on fixed income markets. Now, what I think is important here is not only the past, but what it means for the present and the future. So as we think about the future, a couple of different ramifications become apparent here. One of which is that as yields move higher, there is a greater level of income that can buffer price moves. So one of the things that took place in 2022 is that there wasn't a huge amount of income coming off of fixed income securities that allowed for that price buffer. So as interest rates rose, prices fell, and there wasn't a lot of income to offset that price movement. Now, where we sit today, as you can see on this chart here, if we have interest rates that rise a quarter point, a half a point, what we begin to see is that income is actually going to be stronger than what's called that estimated duration impact. And that duration impact is really just a function of interest rate movements, either up or down. And that's where you get that price change on the fixed income side. So one of the big developments here for 2023 as we begin to think about it for portfolio construction and positioning is that fixed income is now more relevant and more important than it had been in a while because of the opportunity to generate that income and then the ability of that income to protect against price moves in a portfolio. The last thing I would say is that if interest rates actually begin to fall, you'll see that dual effect of duration impact as well as estimated income becoming stronger than it had been in quite a few years. So as we think about what's on the horizon for 2023, we think this is a big, important evolution and change for portfolio construction and markets, and it's one of the things that we're paying attention to and giving a lot of credit to. I hope you found this interesting and useful, and we'll be back next month with another edition of Markets in 2 Minutes. Thanks very much.